Diving into the Lion City's market maze for 7 Nov 2025. Hello, fellow investors, and welcome back to the Investing Iguanas Daily Market Pulse. It's your favorite financial reptile, Iggy, here to break down the SGX action. Our community is growing faster than ever, and I'm thrilled to be ranked among the top finance channels for retail investors in Singapore. We're clocking in thousands of watch hours, all thanks to you. Today, the market is sending us some seriously mixed signals. We're seeing big strategic pivots from the giants, while other sectors are feeling the squeeze. Let's get right into it and figure out where the opportunities are. As the trading week wrapped up, the Straits Times Index, STI, showed some resilience. However, the real stories weren't in the index, but in the individual company announcements. We saw a flurry of earnings reports and corporate actions that are setting the stage for the weeks ahead. It's a classic stock pickers market, where digging into the details is more important than ever. First up is OCBC. The bank reported a third quarter net profit of $1.98 billion, which was essentially flat but still managed to beat analyst forecasts. However, their net interest income saw a 9% dip to $2.23 billion. On a positive note, their non-performing loans ratio held steady at a healthy 0.9%. The market seemed to like the news, nudging the stock up to 17.19s on Thursday. Iggy's take. A profit beat is always good to see, and it shows OCBC's strength even in a tough environment. But the drop in net interest income is a yellow flag. It tells us that the pressure from higher interest rates is finally catching up, squeezing the bank's margins. For investors, this is a sign of stability, not exciting growth. OCBC remains a solid dividend-paying cornerstone for a conservative portfolio, but don't expect fireworks. The low non-performing loan ratio is the real hero here, proving the bank's loan book is rock solid. Next, let's talk about Singtel. The telco giant is making big moves. Its unit, Pastel, is selling a chunk of shares in Indian carrier Bharti Airtel for as much as $1.2 billion. At the same time, reports say Singtel and KKR are in talks to take full ownership of Telemedia global data centers. The market roared with approval, sending Singtel's shares up 5.4% to 4.50 cents. Iggy's take. This is the Singtel I've been waiting to see. They are actively reshaping their business. Selling down a legacy asset like Airtel frees up a massive amount of cash. Turning around and potentially pouring that into data centers is a brilliant pivot to a high-growth area. This isn't your grandfather's telephone company anymore. Singtel is serious about becoming a major player in the digital infrastructure space. The stock's jump shows that investors are excited about this transformation. This could be the start of a major re-rating for the stock. What about the property sector? Capitaland Investment, CLI, saw its total revenue for the first 9 months fall by 25.5% to $1.6 billion. The company attributes this to the deconsolidation of Capitaland Ascot Trust. Before the news, the stock price was flat at $2.65. Iggy's take. Don't let the headline revenue drop scare you. This is an accounting change, not a business collapse. When CLI deconsolidated the trust, its revenue was no longer included in CLI's top line. The real question is how the underlying asset management and lodging businesses are performing. With the stock being flat, it seems the market understands this nuance. CLI's strategy is to be a lighter, fee-generating manager. Investors should focus on their fee income growth, not these accounting-driven revenue figures. Over at the integrated resorts, Genting Singapore posted a solid 19% jump in third quarter net profit to $94.6 million. This was fueled by a 16% rise in revenue, thanks to better VIP volume and a higher win rate. The counter closed unchanged at $73 before the results were announced. Iggy's take. Tourism is back, and Genting is reaping the benefits. The return of high rollers is a great sign for their recovery. It shows that Singapore remains a top destination for entertainment and gaming. While the profit jump is impressive, the key is whether they can keep this momentum. Is the VIP recovery sustainable, or was this a one-off good quarter? At its current price, the stock is still trading below its pre-pandemic highs, suggesting there could be more upside if the recovery trend continues. In the finance world, Yangzijiang Financial announced that its plan to invest 1 billion yuan in a lithium battery producer will not be moving forward. The company stated this won't have a material adverse impact. The stock saw a small 1% rise to 1.66. Iggy's take. When a company says a failed deal has no material impact, you should always raise an eyebrow. While it may not hit the balance sheet directly, it represents a failed attempt to deploy capital into a growth sector. It makes you wonder about their pipeline of deals. For a company focused on investment management, successful capital deployment is everything. This isn't a disaster, but it's a stumble. Investors should watch closely to see where they try to place their bets next. Let's check in on the REITs. Frasers Logistics and Commercial Trust, FLCT, reported a tough second half, with its distribution per unit, DPU, dropping 11.1% to $0.0295. This was despite revenue and net property income actually growing. The units rose slightly to $0.955. Iggy's take. This is the perfect example of the challenge facing S-REITs today. Revenue and property income are growing, which means the underlying assets are performing well. However, higher interest expenses are eating into the distributable income, causing the DPU to fall. For income investors, the DPU is what matters most. This result highlights the headwind of rising interest rates. Until rates stabilize or fall, many REITs will face this same pressure. Finally, Far East Orchard reported that its 9-month net profit more than doubled to $37.6 million. However, this was largely due to one-off gains of nearly $25 million. The stock price ticked up slightly to $1.25. Iggy's take: always look past the headline numbers. A doubling of profit looks amazing, but the one-off gain is skewing the picture. The real health of the company is in its recurring operations. You have to subtract that's $24.9 million to see the core business performance. The underlying story for Far East Orchard is tied to the hospitality recovery. That's what long-term investors should be focused on, not these temporary gains. Iggy's daily market take. Today's results paint a picture of a divided market. You have agile giants like Singtel making bold strategic shifts towards future growth, and the market is rewarding them handsomely for it. Then you have the REIT sector represented by FLCT, which is performing well operationally but is stuck in a battle against high interest rates. Banks like OCBC are the steady players in the middle, holding their ground. This isn't a market where a rising tide lifts all boats. You need to be selective. The key is to look under the hood of each company and understand the real drivers of their performance. Is it a sustainable business pivot or a one-off accounting gain? Is the company building for the future or just surviving the present? Answering these questions is how you'll find the real winners. Thanks for tuning in. I love hearing your thoughts, so drop a comment below. What moves are you making? For more deep dives and exclusive content, don't forget to sign up for the premium newsletter. Let's keep learning and growing together.